GM everyone, welcome to Flywheel, your number one source for everything Frax DeFi and everything in between. If you want to know what's going on in the world on chain, well, you've come to the right place. This is DeFi Dave here with Capital K, and we're here to help you harness the power of the flywheel. And this week we had on someone who saw the whole flywheel and then some. Brought a lot of context to the game. We had on Electric Capital's very own Ken Deeter. Honestly, Kit, I'm not even going to ask you for your thoughts because we're going to get right into it. Because I don't even want, there's so much alpha and so in this episode, and Ken just articulates everything so well that I don't want to take anyone else's time. So we're going to get right into it, everyone. Make sure you hit that bell button, subscribe on YouTube. Make sure you leave us a comment. Let us know what you think below. Give us a like. Make sure you follow us on Twitter at FlywheelDeFi. Join our Telegram at FlywheelDeFi. Follow me at DeFiDave22.
Follow me at 0xcapital_K.
And let's get the flywheel spinning. Do you hold ETH but don't know what to do with it? Want to earn those juicy liquid staking derivative yields but don't know where to start? Well, FrxETH is there for you. FrxETH is Frax's native LSD solution, allowing you to earn boosted yields in multiple ways on your ETH. If you want to get started, go to app.frax.finance and turn your ETH into FrxETH today. Welcome back, everybody, to this week of Flywheel. And today, we're going back to our roots a bit. And we brought on a new friend with us, back into the roots, because we're going to get deep into Frax on this episode of Flywheel. And we have on general partner at Electric Capital, Ken Deeter. Ken, how are you doing today?
Great. Thanks for having me online.
Thanks for coming. And I have to say, I've never heard so much praise for a group of people or VC than Sam has for Electric. He has nothing but the best words to say about you guys and how supportive Electric has been over the years and everything about it. So, I'm really excited to have you on and to just dive deep into your Frax thesis and, everything about DeFi.
Sure. Yeah, appreciate it. We love working with founders. We're all either founders ourselves or people who've spent a lot of time building products. So yeah, that's where we like to connect with teams.
Yeah. So we'll get right into it. So what makes you so excited about Frax, and how does Frax fit into your thesis and worldview?
Yeah, so I guess maybe just to get one thing out of the way, I have to. My lawyer makes me say certain things when I come on these things. So I'm here in my personal capacity, not speaking for Electric. None of this is financial advice or investment advice, so please don't take it in that way. Otherwise, happy to dive in. So in terms of our general thesis, we published in 2018 this programmable money thesis. It's on our website. That was kind of a popular term back then, but we really believe in that idea that blockchains are make a fundamentally different trade-off in terms of how you build software. Prior to blockchains, it was all about move fast, break things, scale up really quickly, and it was all about speed and scale. And blockchains actually really flip that on its head and say, oh, it's not about speed and scale. It's about redundancy and robustness and safety and correctness and immutability and all these things. And when we look at that, it's easy to see why money and it starts with Bitcoin, but money use cases are really perfect for this kind of platform. These are the use cases where all these properties actually matter the most. And so, that was in sort of 2018. As we move forward to today, I think DeFi is sort of the manifestation of that core idea. And so we've seen all these services come online. And so we're big fans of DeFi, obviously, and I'm personally a huge fan of DeFi. And within that, I think it's been clear over the past 3 years that stablecoins have a huge sort of TAM in that market. It's one of the biggest use cases. we're developing all of this in essentially a dollarized world, though, that's starting to change maybe a little bit on the edges right now. But, for the most part, dollar dominance is still very strong. And so dollars as a product, if you think about it as a currency, is a very strong product everywhere in the world. And a lot of people want access to that. And there's lots of barriers to that. So it makes sense that stablecoins are a huge kind of first use case for DeFi. And so, yeah, obviously Frax kind of fits into that. Frax starting on the USD side fits into that idea really well. I think the interesting thing that continues to sort of make me very interested in this space is that I think the Frax team has realized that stablecoins are sort of a generalizable concept. And this is the kind of the stablecoin maximalism that Sam has started to talk about recently. But I think at the end of the day, stablecoins are actually how asset like rehypothecation happens within DeFi. It's sort of like the core mechanism. And if you think about what traditional finance is, it's sort of rehypothecation on top of rehypothecation. It's just layers and layers of this stuff. And so now that we've sort of found the kind of core primitive that lets us do this, the scale of that will probably even be bigger than USD, in the long run. And we're starting to see that with FrxETH and things like this. There are other assets that are going to fall into this type of pattern. And so at the end of the day, the thing that really excites me about it is that, actually this thing applies to, kind of all of finance, not just dollars.
Wow. So yeah, for those unfamiliar, stablecoin maximalism is basically this three-pronged system where you have the main stablecoin, you have the risk-free rate, whatever is the safest asset, that whatever of said reference peg of the stablecoin. So US dollar, that's treasuries. And then you have the swap facility. So that could either be like dollars to stablecoin, curve pool. That's basically stablecoin maximalism in a nutshell. And you said something interesting there. You said that you actually think there are, stablecoins outside of USD that could be bigger than USD. I mean, we already see FrxETH growth. What other ones do you see, like maybe in the future, that could be bigger than USD?
Yeah, well, I mean, there's sort of a general question of do you believe USD continues to be dominant? The interesting thing about all this is, if I don't know if it's RMB or if it's euros or whatever, all these things, the nature of fiat coins or fiat money is that there is generally some central bank that plays this game with interest rates. There is some risk-free rate that is very similar to the staking rate, in proof of stake systems. That I think that structure is going to persist, and it is sort of like a fundamental feature of like economic organization and economies forming around a currency. And so as long as that exists, it might be dollars today, but 50 years from now could be something else. And there's no reason that this stuff wouldn't apply just as cleanly to that type of situation.
Yeah, absolutely. Yeah, absolutely. I'm personally like very bullish FrxETH. I mean, that's like today, if you're looking at like things that are live right now, that is the risk-free rate of DeFi, just getting those proof of stake validators up. And like you've seen like the massive growth of FrxETH as basically it's proven the stablecoin maximalist thesis. I actually, when I was on my trip, I was able to ask a question of Balaji at Pragma in Tokyo. And I asked him about Flatcoins, which is, coins that are hedged to inflation. Him and Sam talked about it back in 2021. And he actually came up with this thesis that although the dollar is the reserve currency right now, and it's like reserve currency, unit of account, he expects that to basically decentralize, quote unquote, in the next decade or so, where like, some, currencies are like the Rumbi, the Real and others could be the medium of exchange, Ethereum, Bitcoin could be store of value and whatnot. So what is your take on, this concept of Flatcoins, especially relative, that's relevant with Frax and FPI, and Balaji's kind of proposition that, hey, like the dollar, like the power of the dollar will basically spread across different currencies and, values, stored values.
Yeah. I mean, so I definitely am a believer of sort of that multi-currency world in the future. I think up until now, there even today outside of crypto, I don't really feel the need to own a bunch of different like fiat currencies, like because it's not useful in my daily life, and I'm not hedging currencies in that way. But as things become more digital and the sort of like associations and groups that we form with people become more arbitrary and multifaceted and kind of overlapping, it makes total sense to me that we develop different currencies that are for use in different economies. So, I think on one extreme, you sort of get into that network state kind of a conversation. But yeah, I mean, I think what you're starting to see with a little bit of the de-dollarization that's happening is like those pressures, right? Like the economy is the natural state of the economy. I don't think is to have one monopoly currency, because people in general, like, the whole world doesn't agree on hardly anything, right? And so why would you expect it to agree on how money should work, other than by historical coincidence, maybe someone was super powerful for a while and could force that on everyone. But I don't expect that to be the natural state, and I expect things like crypto to accelerate towards going to a place where a lot of these things exist in parallel.
So do you see crypto as this non-aligned technology in this, future multipolar world that, different nations and agents and just sovereign organizations in between can use to, as a sense of refuge away from like, oh, I don't want to deal with like this fiat or that fiat. I don't want to pick sides. Let me just like go to crypto and, do my business over there.
Yeah. I mean, I don't see it necessarily as crypto versus not. I see crypto as sort of like, it's kind of the monetary equivalent of like what the printing press did to like religions, right? Like, I think back in the day, information distribution and sort of the like organization through religion were sort of like coupled, right? And today, I think sort of monopoly on violence and monetary systems are coupled, and blockchains come along and say, well, you can actually do this, money part without that other thing. And we don't have to have these together, right? And so, just in the way that I think over time, freedom of religion became this concept, and we had to like basically move to a whole new continent to really explore that idea and set up a new governmental system around that. I think we're kind of doing that in the metaverse now, right? Like, this internet is sort of the new world, and there's no reason, now that we have the technology to do this, there's no reason to have have this thing governed by the physical jurisdictions that we sort of came from. And instead, we have this technology to be able to create all these different monetary systems in parallel. So, why wouldn't it end up that way? Why would we end up in one system like we started with?
So what are your thoughts on Balaji's concept of the network state? Because this like completely reminds me of this.
Yeah, totally. I mean, I think it's very interesting. He likes to think through things to their logical extremes, and they're very interesting kind of thought exercises. I think some of the things about how the network state sort of manifests in physical reality are like, at least feel to me a little far-fetched, but I can't, everything, the thing about what Balaji says is it's hard to rule out completely either, right? You're like, I could see a path from here to there. Right. And so, I can't categorically reject it either. And he's been right enough that like, it would be kind of dumb to do that.
A true contrarian. Yeah. I think when it comes to network states, the big argument of network state formation is, do you need the physical location first and then the people come? Or do you need to have the community first and then you find a physical location? After like, talking to a few people, I think you need the community first and have a strong sense of purpose and why, and then you get the physical state. And we've actually seen this happen before with Zionism in the earliest 20th century. It was a group of Jewish people that were like bonded and by an idea, organized and pursued it, and were actually successful and founded a nation state. So we'll see like what happens like that on the network state level.
Yeah, totally. One of the things, maybe not to belabor this topic, but so I spent a lot of time at Facebook before I joined Electric. I was there for almost 9 years. One conclusion that I've come to over the last 4 or 5 years, really being full time in crypto, is that I don't think you end up with crypto without social networks coming first. And the reason is that you need humans to organize in a certain way before needing your own currency to like exchange value within that system, right? And so whether it was Bitcoin talk or whether it was Twitter or Reddit in the early days of crypto, you need these organizations of people like the people that like the Bitcoin sort of economics appealed to were always there. They were just dispersed and disorganized, right? And the internet comes along and the social network comes along and says, oh, here's a way you can actually coalesce and coordinate your activities. And I think you need that before, Satoshi can come along and say, well, here's actually like a currency system that can work for you and get any kind of broad adoption around that. So that's just another way of what you're saying, is that I do think the internet has fundamentally changed how humans organize. And over my lifetime, over, my kids' lifetime, their kids' lifetime, that's going to slowly reflect onto physical reality, and whether that ends up in the Balaji version or not, it's up for debate. But
honestly, it seems like Web 2, unpopular opinion, Web 2 has been the perfect playing field for crypto to grow and blossom. People always talk about like Web 3, but I feel like Web 3 is going to look nothing like Web 2, and it can't. Otherwise, it just won't be as good as Web 2. It'll be like Web 2, like bad copy. I want to. There's a few different directions we can go. So you said you were at Facebook for 9 years. What did you do at Facebook, and what did you learn during your time there?
Yeah. Oh, that's a whole nother podcast in itself. So I was mostly an engineer there. Spent a little bit of time as a product manager as well. But I had the fortune of starting in the newsfeed team back in, when was that? 2010. So this was the front end newsfeed team was 4 people, if you can imagine that. Wow. Facebook was, I think it was sub 500 million MAUs at the time. So pretty early on in terms of the
I remember pre-newsfeed Facebook.
Yeah. And bring back the old Facebook kind of protests and all these kinds of things. Yeah. So there's a lot of things that I learned there, but funny enough, I tell people a lot that I think my time at Facebook actually really prepared me for crypto in a lot of ways.
How so?
Facebook, one of the things you learn very quickly is that, we had this model that it's never as good as they say, and it's never as bad as they say, right? And so what that means is that, when you're on the inside and you know what's actually happening, you can see you can see all the data, you can see all the fundamentals, who's working on what the actual problems are. That can get very divorced from what the rest of the world thinks you're doing. The rest of the world sees protests, and in one election cycle they're cheering on Obama. In the next election cycle they're like pulling their hair out about Donald Trump. Like just the fluctuations of the media and everyone around you, exaggerate things in both directions, right? And I think crypto, just by its nature, adds sort of a financial element on top of all these things. And so people are incentivized to exaggerate things, more in each direction. And so having that sense of like, why is everybody so excited about this? I don't think this thing is like working that well. And also like, oh my God, everyone's like, talking shit about this thing, but actually it's working. I can see that it's working. Having that kind of skepticism for like the kind of the crowds like mentality, and being able to see through that is actually like an extremely, extremely useful skill in crypto, because crypto is like, I would say like, 10 times worse than even social networks in terms of the amplification and the bubbles.
It's like, how does the human mind handle such volatility, whether it's like on their news feeds being, fed this information by the almighty algorithm, or, or in crypto when you have like, this hot new coin or hot new this or hot new fad or hot new meta come out and everyone's just jumping on it, and then it just numbers go up and down on a screen just extremely fast. It's like, can the human mind like comprehend all this?
Yeah, I think it can, but it has to learn through like mistakes, right? One of the fascinating parallels with social media is that there aren't as many regulations about like what you can say and what you can't say, right? And that's why we ended up in this whole like misinformation like mess, right? But it's interesting because we used to talk about like memes and misinformation sometimes as a virus. If you think about like a computer virus, right? like the solution is to go and update everyone's antivirus software so that the thing stops spreading, right? But misinformation is a virus of sort of your mind, right? Like the memes are viruses of the minds, and we can't go and update everyone's antivirus definition. You know, that's like education, you know, so to speak, right? And so it's really fascinating. I think a lot of what financial regulation ends up being is sort of our our collective antivirus to a lot of this stuff, which is, you know, great. Like it has really enabled the creation of a lot of different types of safe markets for people, you know, over history. But the flip side of that is that people have grown up in this system. They don't know what an unregulated space looks like, right? And so their brains are not trained to recognize, you know, what is a scam and what is not, and kind of like all these types of things that happen. And so I do think, and historically you see this when like new types of financial assets appear in the world, that there's a lot of like scamminess around it, because people are taking advantage of that information asymmetry that exists right at the beginning when something first appears. And so, yeah, you know, it's interesting to me that I do think over time, just in the way that like if one of us were to see like an email scam or a chain email or something, we're like, oh yeah, that's bullshit. Like, why would anyone fall for that? You know, there was a generation maybe or two prior to us that would totally fall for those things, right? And that's what those things are targeted for. And, you know, just like that, I think we're somewhat immunized to news feeds now. Like people who have grown up in our generation sort of know how to process that. But, you know, crypto's like a whole nother ball game. Yeah. And so, you know, there's this mix of like, how do you sort of build the natural like herd immunity to this stuff, so to speak, versus like how much do you sort of like control it at some kind of centralized level.
I really like that. I really like that comparison you put forth between, you know, actual like viruses and financial markets, and like growing immunity, growing like this financial kind of immune system against scams, against you know, seeing through stuff and whatnot. After this, I actually want to get into Web3 Social now, because you worked in social media, and now you know, Web3 Social is becoming a thing and a buzzword. Sure. What are your thoughts on it? And like, what do you think it will look like? Is there anything promising you see right now in the field?
So, you know, we obviously monitor the stuff that's happening right now. A lot of it, to be honest, feels like kind of what DeFi was at the beginning, which was like, oh, let's look at TradFi and see, you know, what kind of products exist, and let's, you know, more or less try to replicate those same financial services on chain, and, you know, maybe we get some of the Web3 kind of, you know, permissionlessness and decentralized, you know, control type of benefits on top of that. A lot of what I see in Web3 Social sort of feels like that right now, whereas it's really the things like, you know, AMMs or like these funny stable coins, or like these sort of second, third generation, like really native things that provide services that like the prior like incumbents can't provide, right? Like always on liquidity for long tail tokens. You know, like that's like a thing that like we don't know how to do in a centralized way, in a regulated way. And so that, you know, that's where kind of Uniswap and DeFi starts to creep in. And I haven't seen sort of what that is for social yet on Web3. That being said, you know, I think depending on how you think about how well certain social networks are being run right now, there might be an opportunity that arises just because there is sort of like a political will to move off of those things. That being said, it's not as easy as it's not like you just create some kind of decentralized system and it works, right? Like,
you probably need something like ZK to come along, because, you know, with you know, block, everything's on chain, it's open, it's transparent, which is great, but, you know, you don't want to have everything completely open. Like, you don't want to signal like, hey, like I have, you know, this much ETH, or hey, like, you know, I have this or that, because you can put yourself as a target. But if you can like signal that in a safe manner, that could be something interesting.
Yeah, totally. And I also just think like a lot of the problems that current social networks, even the Web2 ones, face, they're not really tech problems. They're like human problems, right? The real problem is that like, we as a country in the US cannot actually agree on what is okay or not okay to say on a social network. And because we can't agree politically, we just like push it down to the actual companies, and they're like, well, if we're damned if we do and we're damned if we don't, right? So
then they get blamed for it.
Yeah, exactly. So that is literally the state of play right now. So yes, like you can move it to like a decentralized architecture, but fundamentally, what controls these things, how you design these things, is a kind of political process almost. And I don't think any amount of technology is really going to change that.
Yeah, and I want to bring this back to Frax, because we were talking about innovative DeFi. From your observations, what do you think has been the keys to Frax's success? And what do you think Frax has done right where other stablecoins have failed?
Yeah, so I think there's a few different things. I think from the mechanism design, not going all in on the seniorage model was like, we definitely saw our fair share of like degen kind of models here. And I think they were all, interesting sort of as like mathematical primitives and social primitives, but clearly, I guess it's sort of this like endogenous stablecoin kind of moniker that's been floating around. Things that are like purely self-referential and purely reflexive, at least don't seem to work as of today. And so I think being conservative about the collateral ratio and things like that, I think that was actually a very important part of the design that allowed Frax to survive, through all that kind of carnage in the other designs. I think the other big part is Frax was probably the first protocol to understand the curve game really well, understand both the fact that the swap facility needs to exist, but also that because of how the curve tokenomics work, you can actually benefit from providing liquidity, swap liquidity into your swap facility. So, and they've got out to like a huge head start because of that. And I think they still are state of the art in terms of thinking through those mechanics. And then probably the third thing is they just ship really fast. If you think about just like in the last year, I think even a year ago, like we didn't have FraxSwap, FraxLend, FPI, Frax, like all these things happened, within the last year. And I look around at other large DeFi protocols and, like Compound, like hasn't really shipped anything. Obviously sort of moving, Uniswap sort of, maybe they'll do a UI or, I'm not exactly sure what their plan is, but like, yeah, just like the pure velocity is like incredible for this team. And so, I think that's also kind of to your earlier question. It's one of the reasons I continue to be like excited about it.
Yeah, it's like, the new mantra I've been saying about Frax, because, now that they're going up to 100% collateral ratio, it's hard for people to envision that as fractional. Now I just say Frax actually is short for fractal. Frax is a fractal of all of DeFi. If you want, want an LSD, you got it. If you want to swap, lending, everything, a microcosm of DeFi is basically Frax. And that's what I've been using now. But I'm wondering if is there anything that you use? Like if you were to describe Frax to someone who's familiar with DeFi, but might have heard of Frax once or twice, but isn't too familiar with it. How would you describe Frax to them in a few sentences or in a simple explanation?
Yeah. So there's two ways I like to explain this. One is if you're familiar with ETH staking derivatives, I think ETH staking derivatives is actually pretty easy to understand. It's you can stake your ETH, you can earn interest, but this ETH is just sitting in this kind of relatively safe place. So why not be able to use it as money as well? What if we just created these IOUs, and manage that through a smart contract? Like you could have this sort of ETH on chain and pass that around and have that just be claims on something in the sort of ETH bank, right? And so I think if you understand that, then really it's actually pretty easy to then map that over to the dollar side, right? Like what Frax is doing on the dollar side is literally the same thing, except instead of staking, the backing asset into the L1 staking system, it's either lending it out or it's sort of staking it into, TradFi, right? And if there's a yield to be had there, then it's really exactly the same equation. So So that's sort of one angle. If you're sort of more crypto native and at least understand what ETH staking is, then I would come at it from that angle. The other angle that a lot of people are familiar with is that if you go on a brokerage today and you buy T-bills, if you buy like things that are less than 30 days, often that brokerage will allow you to use your T-bill position as cash, right? So they'll say, oh, if you want to underwrite like a margin, like a options position or something like that, they're like, well, this thing is basically as good as cash. So for the purposes of your account, we're going to let you treat it like cash and fund some of these other, leveraged positions that you might want to do. If you think about what that is, that's exactly what Frax is doing on chain, right? It's just that instead of doing it inside of a closed system, like inside of one brokerage, you're allowed to do it, across all the systems in DeFi because there are smart contracts, and you can sort of understand the guarantees that a smart contract makes around, the custody of that backing asset. And so, yeah, so it's basically, T-bill rehypothecation for everybody in a very generic and open way that matches what DeFi wants to do.
Yeah.
So yeah, those are kind of the two ways that I kind of come at this.
Now, Ken, that's actually very interesting that you kind of bring that up, how using T-bills is pretty much cash equivalent. And we see the similarities there with, say, the Curve LP tokens for Frax's AMO, right? They take the Frax 3 CRV or Frax base pool and they pretty much treat that as cash.
Yep.
And so I wanted to kind of double click into that. And you said Frax is so integrated with the Curve ecosystem. Do you feel that that is pretty much the state of play for stablecoins in the near future? Meaning, if any new stablecoin were try to come into the market, they need to enter in the Curve and the Frax flywheel and play this game to be in the on-chain stablecoin market.
Yes and no. I think as of in this particular moment in time, it's hard to not play in Curve. Just because I think Curve has the most, it's not perfect yet, but I think the most developed kind of tokenomic structures. And so in terms of being able to amass V Curve or convex or, whatever it is, and then incentivize liquidity into your swap facility, I think that is like a key feature of any stablecoin. Frax was the first to demonstrate this, but I think anyone coming along after them has to realize that like this is like a pretty efficient way to do this thing. And so until that changes, I don't see where else you're going to go. I mean, I guess you could go incentivize a Uniswap pool, but Uniswap doesn't have the same sort of mechanics in terms of its own token. And I think over the long term, once you end up with a bunch of V Curve holders or convex holders that are locked in for a long time, it's going to be very hard to displace Curve. So I don't know if like the book is completely written yet, but in terms of the market today, it's hard to really imagine alternatives.
Yeah, I guess the only alternative would be is if U.S. regulation suddenly turns bullish. Stablecoin regulation is clear. Banks can issue stablecoins, and then you just have someone like JP Morgan like come in with like a $10 billion on-chain stable swap.
Yeah. I mean, well, but what would that be swapping against, though? I think actually the swap facility being like I think a lot of those fiat-backed stablecoins, if this does happen, there's like some legislation that's like sort of being worked on right now, but like if that does happen, the fiat stablecoin issuers are sort of like the ETH staking operators in today's world, right? They sort of handle that like last off-chain piece, but I don't think that naturally gives them an advantage over something like a Curve, which is like a fully decentralized, system here that has its own incentive mechanisms.
Why don't you think that it's an advantage?
I mean, it can come in and do it, but like why would unless they did like sort of a sushi style thing against Curve, I don't know. I don't know why people would switch over. And on top of that, like it's like something like half of like Curve tokens are already locked in for like some period of time, right? So there's actually active disincentive for people to go and use something else. So yeah, I think probably if JP Morgan were to do that, they're going to have to find some other like kind of slice of the market, which might be like, compliant, like KYC, trading or something like that. Like that's something where, Curve doesn't sort of explicitly have a footprint in, that they'll probably, they might be able to carve out and bring a lot of liquidity to in Bootstrap.
Yeah. What's interesting about Frax, Curve, and Convex is, they're all intertwined with each other, pretty deeply, whether, Convex owns a bunch of Frax and Curve. Frax has like a base pool, and all this vice versa. And this seems like the new way that it's not like exactly a merger per se, but they're all like pretty integrated. Do you see this like kind of new development in DeFi, like just how things are going to operate going forward? Do you see like traditional mergers happening in the future? I think we've seen like a few attempts at mergers that didn't go well. So like, how do you think of this like kind of like, kind of this like confederate system of like, oh, like you own a little bit, I have a little bit of that. We all complement each other really well.
Yeah, totally. This is a very interesting debate I have all the time with people. It's sort of the clean kind of like hypothetical example is like, what if you have three protocols that all own a third of each other's tokens, right? Are they different protocols at that point, or are they the same protocol? I tend to think, well, we'll see. I suspect that at least for, the next few years that we're not going to see a lot of mergers per se.
Yeah.
And the ones that we've seen sort of didn't really seem to work.
No.
And I think it like kind of concentrates the decision-making too much in a way that's like pretty incompatible for how DeFi works. That being said, at some point, if there are like 10 protocols that all own each other's tokens, it also becomes like somewhat inefficient. So it does seem like, if they are really truly incentive aligned, and the communities are incentive aligned as well, then you could imagine, some type of like fusing of tokens at some point.
Maybe some like DeFi SDR gets screwed.
Yeah, totally.
Yeah.
So maybe you get some kind of wrapper token that is like a basket of all these things, and having one of those gets you governance and everything. I do think there are, like, at the end of the day, I expect DeFi, I don't know what to call them. They're not like protocol. Like protocol is too narrow. There are sort of these communities that form around these things that I think eventually will like verticalize into every single type of financial service that they can offer. So, DeFi, like Frax, you're starting to see that, right? They have a capital base, but then there's lending and swapping and all these other kinds of and different types of stable coins and inflation, hedging products and things like this. It's natural for any pool of capital to want to figure out how to monetize its capital in every which way it can. And really it's a question of like, how do you fund the development of those things? And then how do you like kind of build the set of users around, your products, right? And is that through just offering better products, or is that through incentivization and bringing community members in that are like sort of long-term aligned to like support your economy, right?
Yeah. What do you think is the key to building community and users? Actually, you can finish your answer, but like after that, can you answer that question?
Yeah. So what I was going to say is like it's a really interesting contrast to say, one way to do it is to just fund the development of your own, like Frax, I guess, they could have built their own curve, they could have forked curve or whatever and done their own thing. But the other thing is like if you actually have revenue for your product or your protocol, you can actually use that sort of economic power that you earn to like slowly gain control of another protocol, right? Like that, in my mind, that's what kind of Frax has done in a way, is that like, they use the fact that, they have this capital base that they're able to monetize. Let's use that economic power to slowly, acquire curve and take over this system, or at least have enough of a vote in it. And so functionally those two things might be equivalent, and it might actually be, I think it might actually be human factors that decide which way we end up, right? Like, is it actually better, so one angle is like from a decentralization point of view, can you argue, is it a strong argument to say, well, there's actually 3 governance tokens here, and they all can vote in their own way, and it's like nobody has single control because you can look at it and see that. Or is it the fact that like actually at the end of the day, for Frax to win, it actually needs to bring the Curve community on board, and the way to do that is not by funding your own competitor, but actually saying, hey, we're going to work together and we're going to slowly acquire ownership of your token and essentially share economics with you, make ourselves value aligned so that at some end state, basically Curve and Frax communities are like, friendly with each other. They're rowing in the same direction. Is that the right way to do it? Like, we've never been able to like really account for ownership in such a micro level through these tokens. And so, it's hard to shake the thought for me that maybe governance tokens, like actually that's the superpower, is that you can actually create all these micro alliances in a way that, like a traditional entity structure with equity and shares or even governments, like there's no way to do that.
Interesting. Yeah, basically you can layer the governance power on top of each other. And as the community not only like are economically aligned, but value aligned as well. It just seems like a natural fit and a natural alignment. In a way, it's like not that much different than, countries trading with each other, countries developing relationships with each other.
Yeah, totally. Yeah. So one thing I was going to mention is that I do think one thing that's missing right now from sort of protocol to protocol relationships is that, a lot of protocols have sort of a balance sheet or like a treasury. And sometimes they hold some other protocols tokens, but a lot of times they don't like lock up those tokens in any kind of VE system. And I'm pretty sure the Frax Curve is actually locked. I mean, it would make sense for it to be locked up because they want to control the voting side of it. But I actually do think over the long term, you said mergers before. Like I think before mergers, you have partnerships. And I think the token native way to express partnerships is actually the co-locking of each other's like tokens over some period of time, right? Like that's actually what incentive, that's a way to make a promise on chain that says we're going to be incentive aligned for, the next 2 years or 4 years or whatever, right? And so Curve and Frax kind of got there maybe somewhat naturally, but I don't think there's like a Curve balance of like VFXS, even though there's, the other way around. And so it's not even like fully formed there yet. But I think those are the things that are actually going to predate, kind of full on mergers.
Yeah, you need to have these steps ahead before you get on full on. Yeah. A few months ago, I mean, it might have been more than a few months ago, time flies, when, Frax agreed, like when Frax got whitelisted for, get CRV, and now they started locking for VCRV. So that happened, but yet it hasn't happened the other way around just yet. Rewinding a bit, I want to get back to my question about users and community. What do you think is the key for DeFi protocols, especially and what do you think Frax and Curve has done so well to keep users and community around? There's always some hot new shiny toy, that pops up on the timeline, but to really build and dig in to a protocol over the years and have this loyal community around, it takes a little bit something more. It takes us a little bit something more than just price. So what do you think Frax and Curve have done so well in that regard?
I think there's a few things, at least that I point to when I think about Curve and Frax as case studies. One is that they actually built something that was useful. It's hard to retain enthusiasm and community around something that just think doesn't actually provide value. So that's sort of a baseline thing, but people seem to forget that sometimes. I think the couple other things that they did were they actually gave people a way to express long-term alignment with the protocol. So and this is in the form of this vote escrow stuff, right? The really interesting thing about vote escrow is that it lets the hodler self differentiate into I'm just here for to dump versus I'm here for the long haul. And then again the governance system rewards that sort of self-selection into different camps, right? And so if you think about other types of protocols that don't have this, you're essentially saying that the economic risks and rewards for someone who is there to hold for a long time is the same as someone who's there as a mercenary, right? And if you do that, then usually the economic sort of risks favor the mercenary rather than the long-term holder, right? And so I think like the first key step is to just even have a way for people to express their long-term alignment and be able to reward them or be able to bring them into the community more deeply because of that. So that's sort of one key ingredient. The other key ingredient, like I mentioned, is like you have to have something that's useful. But in this case, I also think it means that it's something that like generates revenue or has like a real like economic substance to it, which then allows the third piece, which I think actually like gauges are like a really fascinating mechanic for building this type of community. And what you notice in like Curve proposals, Convex proposals, Frax proposals, is that there's a ton of engagement because there's actually like real dollars being allocated. I think we did the math at some point, and there, it's like millions of dollars a week of incentives across the Frax gauge being, distributed to these, these liquidity pools and these protocols that are downstream, right? And so, you're actually asking. You're doing two things. You're saying, hey, community, please help us make this economic decision. This is real dollars on the line, right? This isn't like, what the logo should be, or like, something like this. It's like real. So there's a lot there, even just through financial interest, there's going to be a lot of participants in that system because attracting Frax incentives can really, help another protocol, right? But then it also did it in this way that said, hey, if you're long-term aligned with us, we'll actually give you more say in this thing, right? And so it creates this kind of natural flywheel, which, this is mostly kind of what the Curve folks, kind of pioneered. But I think Sam and the Frax folks were like very early to realize, oh, actually this has a lot of positive network effects in terms of our community. And so that, when you go from the bull market to the bear market, what has kept people around? Well, it's because, I think it's because of two things. There's real economic decisions being made in this community, which gives you a reason to stick around. But I also think there's kind of this also self-reinforcing effect where now people can look on chain and say, actually, I think both FxETH and Curve have like 40% of their tokens locked up. So you can look at that and say, oh, actually, there's like a lot of long-term holders around here. And so I can also not only understand that right now it's important to participate in this, but that like a lot of people around me have made a long-term commitment to this thing. And that social proof doesn't exist in a lot of other protocols.
This is the real Web3 social right there, expressing it on chain, honestly.
Yeah, totally. Yeah. It's like when you say you're friends with someone on Facebook, right? That's like a vote escrow of some sort, right?
A friend.
How committed are you to the friendship?
Yeah, exactly, right. And then that's why they have the relationship status, right?
Yeah. So Ken, you've said the word long term like quite a lot in the way you express what you believe a community should be centered around. But I want to double click in and understand what does long term mean? Is it that maximum 4-year lock, or is it just more than the 1/4 of the narrative in crypto? Because obviously the space is very young and nascent. So how do you think about the word long term? And do you think it's currently best expressed with a 4-year maximum lock, or should it be more? Or is there a magic number?
Different way to express it?
Yeah. Well, okay. So when I say long term, I think about all the other sort of fundamental tech shifts that I've seen over my lifetime. I am maybe a dwindling population of folks that remember like pre-internet, right? And I remember, sitting there on my dial-up modem, like ordering something for the first time online. And I'm really going to date myself, but like prior to that kind of stuff existing, like if you wanted to order like, what was it? Like CDs, like music CDs, right? You got this like paper catalog, right? From the music company every month. And then there's a little form in the back where you would, tear it out and write down all the numbers of the CDs that you wanted. and include a check and send it to them over the mail. And then maybe like in a few weeks, you'd get this box full of CDs in it, right? And when you go from that to like, oh, I can just go to this website and type some stuff in and it like shows up, you know, and we use my friend's dad's credit card. Like that experience, this is like, you know, what, 1998 or something, right? This is like, you know, you're like, oh, this is how everything is going to work in the future. But how long did it take to get from that moment for me personally to like, you know, where everyone around me, even my parents, my grandparents, take this for granted? That's a 20-year process, right? And so you see enough, and you know, it was the same thing for mobile. It was the same thing for social. Like a lot of the folks that were there early could see where it was going to go, but to actually get there is a decades-long process. Crypto, you know, I suspect because, you know, finance has a lot of, you know, regulatory and these kinds of, you know, it's kind of the reason why a lot of nations exist today, or is like a core part of it. So I think unwinding a lot of that is probably going to even take longer. But when I think of long term, those are the timescales that I'm thinking about. And when these things become truly valuable and truly a part of society and achieve the sort of scale that we think about as technologists, like that, you know, those are decades in the making. So yes, in terms of long term, that's what I think about. Now, your specific question about whether 4 years is enough, I tend to think 4 years is just sort of an arbitrary limit. There is, you know, and I don't know like why, you know, the Curve folks decided to stick with 4 years. I know that the VE Curve contract gets like forked a lot, and so it probably just, you know, it's probably like that 4 year thing is like propagating through copy paste.
Yeah, maybe because of 4 year cycles.
Yeah, and also like 4 years seems like an eternity in right. DeFi and crypto in general. So, you know, I suspect that at least for now, that the diminishing returns beyond, or like the additional amount of risk that you're taking on by going beyond 4 years is probably like very diminishing, and so it doesn't matter in practice. I suspect that as more things stabilize and this stuff becomes better understood, that yes, 4 years will not be enough. Like we have, you know, 10-year treasuries, we have 30-year treasuries, right? Like all these things are similar types of long-term commitments. And so I don't see why you wouldn't expect a longer term kind of commitments to show up in, you know, these crypto.
If only there was some market to trade this locked commitment.
Yeah, exactly.
Yeah. I wonder.
Plug Hourglass. But I also wanted to. I saw your Twitter thread regarding this locking and VE locking, and you mentioned it's more than just the governance token could be locked, right? Like the actual liquidity in, you know, the pool providing for the protocol could be locked as well, and we see that with Frax, and I feel Frax is one of the earliest ones to pioneer this lock liquidity. It's not protocol owned liquidity, it's definitely not, but it's user lock liquidity into the protocol. Now, do you see that as a key when compared to projects just airdropping tokens freely and completely without any burdens and fully unlocked? Do you think projects should start adopting this? Hey, you should airdrop them locked, or you should airdrop them as liquidity pool position, but also locked, and always aligning that back into the project?
Yeah, totally. I think most reward schemes we've seen, you know, accepting like some of the Curve and Frax stuff that seems to be working. I think most of the stuff we've seen is like very, very like value misaligned, right? That's why we have mercenary liquidity. That's why we had this like crazy DeFi summer where, you know, people were just forking protocols left and right and, you know, emitting a bunch of tokens, and then liquidity shows up and then it disappears, right? Like, because the incentive models don't, like, there's no reason to have the liquidity in there, putting it at risk, you know, at impermanent loss risk, if there's no rewards attached to it, right? And so, you know, and yeah, happy that you guys brought up Hourglass. I'm a big fan of what Charlie's up to over there as well. But you know, once you start thinking about all this stuff, you actually kind of realize that like a lot of crypto and DeFi especially is premised on this sort of like in the moment thinking, right? It's like you get all the tokens are like, you know, fully fully unlocked. And actually, if you go back to ICOs, you can sort of see that thinking with ICOs as well, right? It's like when we look back at ICOs, we're like, well, actually, maybe raising a bunch of capital and releasing a bunch of unlocked tokens right at the beginning with no sort of long-term incentive alignment was probably not, the right thing to do. And you see the reaction to that was actually, we actually fell back to more traditional structures like, SAFs and token
Vesting
warrants
schedules.
and vesting schedules and things like that, right? And so, that ICOs to me were a moment where DeFi kind of had to relearn the fact that actually, okay, you could do this stuff on chain, but you're not going to change the human part of it, which is that people, need long-term reasons to stick around and keep paying attention to something. And so I feel like now we're starting to learn that with liquidity mining, with airdrops, with, all these kinds of things where what you actually need to get people to take on some kind of risk if you're going to reward them, right?
Skin in the game.
Yeah, exactly. And skin in the game is not just liquidity that I can put in your protocol and just leave there and then pull out instantly whenever I want to, right? Skin in the game is I'm going to make a bet on the future that the opportunity, the benefits that I get from earning, some governance token for providing liquidity in this thing over a 1-year period, a 2-year period, is going to outweigh the opportunity cost of having that liquid or being able to put somewhere else, right? And again, just in the same way that VE curve or VE models allows governance token holders to express that long-term bet, locked liquidity in the Frax style or in the Hourglass style is going to allow people to do the same thing. And if you're a smart DAO on the other side of that, you're going to say, oh, you know what? Why would I treat the mercenary liquidity providers the same as people that are willing to put this in for, a few years? Because the long-term committers are way more valuable to me than these short-term mercenary folks. And so, I think we're going to see a lot of, quote unquote price discovery around these types of things in terms of how DAOs think about incentivizing and bootstrapping their liquidity in the beginning.
I think what's more even interesting is the ability for crypto to allow these type of tiered level of commitments, right? But also one step further is what Charlie's doing that's enabling the market to decide actually maybe I was 4 years committed, but now I want to change back to being 2 years committed. Hence this ability to kind of slice and dice your decision up even further and kind of come in and change and put a price on it. Right. I think that's the key part, is being able to put a price on something. Now, we've been going kind of deep into the benefits and the great things that come with value alignment and locking things up. But what are some drawbacks, Ken, you think, about this locking mechanism?
I don't know. I guess I kind of see it as obviously you're taking on risk, right? So no one should be sort of, a 4-year locked token is a very, very different beast from a unlocked token. If anything, I think it is healthy for the ecosystem to have these things. DeFi definitely needs these things. I think I worry that every time some new type of primitive comes along, people don't really price the risk correctly in the beginning. And so there probably is some, situation where some people are going to misprice the risk and end up on the wrong side of it, and maybe we'll give you a bad name. A lot of times you see, I think the kind of workplace you see this right now is in the Frax governance. You see a lot of these kind of rage quit discussions, right?
Let's bring that up.
And those are people mispricing that kind of duration risk with these things, right? And they committed too long, and that's especially in a bull market, I think it's tough to. It's just human psychology to be overly optimistic about things, and so you might commit into things that you shouldn't. That's also risk, right? So I think the technology, the primitive itself is neutral, but its introduction into the ecosystem will again take some learning period to figure out exactly how to price these things.
Yeah, I want to go back to locked liquidity. and I have a pretty interesting question. And Kit, you're gonna think I'm gonna like do a little plot twist here. So like I've actually like grown to like look at locked liquidity as a replacement for traditional fractional reserve banking. Like in the old system, traditional banks, because it was opaque and things were slower, you could have these like only like 10% of reserves and 90% lent out. But you know, since everything's on chain and everything's open, you can immediately see those reserves not there, and then people panic, and then you see all these like on-chain bank runs. But with locked liquidity, that guarantees at least there to be trades happening, or like the ability to trade, and gives this ability for protocols to maybe be like a little bit under collateralized, just like a little bit. So but what my question is like, in the future, if DeFi and stablecoins get more mature, and there's like and it actually becomes much more mainstream, and there's hundreds of billions, if not trillions of dollars of stablecoins in circulation, would it be possible to have a stablecoin maybe like a little under collateralized? Maybe it doesn't have to be like backed by the governance token, but maybe it could be backed by like ETH, or maybe by like something else, maybe even the government, who knows. I guess like that's up to the market to decide, but because of like the nature of locked liquidity acting as as the substitute for like fractional reserve banking, does that make sense?
Yeah. I mean, so the way I actually think about that question is a slightly broader one, which is that, do you think in the future a on-chain fiat coin will exist, right? Because if you think about what like US dollar does, is it has, in theory, some backing assets, everything that, is secured by the US military, I guess, at some level. But, through inflationary mechanisms, or through quantitative easing, or debasement, or monetary policy, there is some leverage being taken on that core set of assets, right? And the assumption is that you're not going to get mass redemptions such that everyone tries to get out of dollars, and like we're all sitting around like holding property, or I don't know, whatever it is, whatever you end up with, right? Or gold bars, or whatever you end up with. But so that idea that a set of people can come together and agree to a monetary policy that has that little bit of leverage built into it is nothing unique to off-chain or on-chain, right? And so if you can get 300, once everybody has wallets and is on-chain and is participating in these economies, will we see some economy that says, well, we have a capital base of however many assets, and maybe we own real estate in all the different countries, and it's this network state or whatever, and say we want to actually print more. I don't know what we want to print more Balajis than we can account for in terms of our assets, but we think that's okay because there isn't going to be this mass redemption, and we're going to do it in this controlled way, and maybe it's governed by a smart contract or some DAO or whatever. Like that's essentially recreating a fiat system on top of on top of a blockchain, platform, right? I don't see why that wouldn't happen in the future. That seems like an inevitability as well. It's just that we've got to go through a few steps. Right now we're still at a point where like most of society doesn't actually have the same trust equation when it comes to smart contracts and things like this. So if it's one thing for them to get over the fact that they have to trust this weird technology that everyone, a bunch of like, nerds seem excited about, to, then saying, okay, well, we trust the technology, and we trust the financial aspect of this. So like, let's introduce a little bit of this leverage, and, maybe that's good for an economy or not. But, I just think we're like, we're too early to have those conversations today. But we're going to get there. I think it's in human nature to get there.
Yeah, that's gonna be really interesting. Just central banks cryptographically printing on chain directly. There's no off chain wrapping. You have to deal with no. It's all on chain. That's the future that I'm looking forward to. Not just even with stable coins, but with like housing deeds, contracts, like everything. Like it'll just make everything so much easier, because I view like the idea of wrapping as like so much legal and regulatory weight that it's like it's hard to be like too bullish on it. I mean, I know things are being like worked out, but I I guess this is what leads me to say is like, do you believe that, what's your take on real world assets? Do you think real world assets will have to be the same and everything would be like, have to be cryptographically signed on chain?
I think eventually, yes. But, how that actually manifests in terms of like people's daily lives, I also think we're probably going to end up in a place where, a lot of the solutions are what we would call like custodial solutions.
Yeah.
Like, just like there's a piece of paper down at City Hall that says I own the property that I'm, sitting at right now. If we're okay with that, then probably in terms of the risk parameters, people will be okay with City Hall, holding a bunch of like, seed phrases, or I don't know what it ends up looking like, but right, like something like that, right? So like, there's going to be a delegation of the custody aspect to something. I think.
Oh, absolutely.
Yeah, so I think, but in terms of how we decide, what ledger we use as the like source of truth for who owns what, yeah, I think all this stuff is going to go on chain eventually. It's just like, it makes so much more sense, right? It's so much more flexible. It's digital. It enables all these kinds of interesting downstream use cases.
What do you think the timeline is for us getting there?
Oh, decades.
Decades. Okay, yeah. So we're literally, yeah.
Yeah.
So we're like, everyone's like, oh, we're in like 1995, 1999. No, we're in like 1980 something.
Yeah, I mean, well, it depends on which particular endpoint you're comparing yourself to, but I mean, like, I think it's like if you think about all the things that you need to happen before this can, and kind of to your question about real world assets, I also tend to think that this stuff doesn't, like, we've seen these experiments of like, oh, bring the real estate online or on chain, or like bring this asset on chain. Those things are like cool proofs of concept, but I think we've yet to figure out, there's got to be some real world asset that's actually, it's really difficult to create a market for in TradFi. But it is valuable to have a market for it, right? And so there might be things like, the trading of this asset is like really international and cross jurisdictional, and so it's really hard to understand like who owns what, or like how to even like send the money back and forth or settle these trades. Like, there's got to be something that has those properties where you can say, even if it's like a relatively inefficient market on chain, the fact that it exists is actually already valuable, and people will like flock to it and use it, or maybe that the capital that's already on chain doesn't have access to that particular asset type through any other means, and therefore you just get this natural product market fit. And so I actually think the first place that this is going to happen is T-bills, right? Right. Yeah. Yep. In a low rate environment, nobody cares that Circle has a bunch of sitting on a bunch of T-bills and earning 0.2%. That seems fine as sort of like a custody fee. Suddenly, when they're earning 4.5% and there's like dollars trapped on chain, like suddenly people care, right? So it's and this is just something that I've seen a lot of teams running at right now, but obviously regulatorily very murky how this is going to work. But whoever figures it out, there's probably tens of billions of dollars sitting on chain that wants access to, US backed yield and just has no way to do it right now. Right? So that's going to be I think that's going to be like a pretty big adoption curve. All the other ones, we're probably going to have to see things emerge on chain that feel more like toy use cases that then eventually prove to be useful for real world assets. So one of the things that I always talk about is, we have monkey JPEGs, right? We have these like funny things that seem totally like a toy, but they're worth like a non-trivial amount of money, and more importantly, like the desire to trade and lend against and do all these things with those types of assets has created market infrastructure around this type of asset, right? Mm-hmm. And so once you figure that part out, and maybe you also figure out that you can put it on L2 to make it relatively cheap, once you de-risk all that stuff, then that's where something like a tokenized real estate or like tokenized something else can actually come on chain and be like, look, all the technology aspects of this thing have been de-risked. And so it's actually now when we compare how we're going to represent these assets, are we going to continue to do it at pieces of paper on City Hall or like on chain? Like that's where that decision becomes an easier one to sort of go in the on-chain direction, right?
Yeah, it's like the monkey JPEGs are, kind of our test run built, and we're
Yeah,
building the
exactly,
info around it.
exactly.
And I've actually said to Kit before, hey, the most successful real world asset on chain, USDC, Tether.
Yeah,
and yeah,
it is. It is totally. I mean, like if you look at what a tokenized real estate is, it's some company that's holding a deed, right? And just like Circle is holding dollars in a bank.
Right. And Ken, so on this topic of TradFi, I want to ask you, do you think there is a place for C-DEFI? Or is C-DEFI simply centralized DeFi is a transitional period right now that we kind of need them to get us over to the other side when everybody has their own wallet and everybody's self-custody?
Yeah, so I think that goes back to, I mean, in the really long term, I think that goes back to what I said a little bit earlier. Is like, I don't know that we end up with like self-custody for everyone, right?
Right.
Lacking maybe some like biometric like implement or like some biological implant or something like that they stick in you when you're born or something. Like but even that you still have some trust assumptions, right? So I think most like unless you believe in the total like everyone for themselves kind of like libertarian anarchy kind of world, like I just don't think, like, I think humans are like have kind of moved past that version of the world. So that means that, a lot of your life, a lot of the things that you achieve in your life, you do in your life, has some trust assumptions built into it. And, I think a lot of those trust assumptions are going to continue to be around money and custody and things like that. I mean, honestly, it like, it's cool to be able to self-custody, but it also kind of sucks, right? Like you have to worry about,
super sucks.
Right? Yeah. So like, and so I think that's not going to completely go away. It's always going to be this trade-off. And so to the extent that there is a market for custodial services, I think that will always exist. Companies will form or organizations will form to serve that need. And, I think you can point at that and say, in the long term, that's what really C-DeFi is. I also think it's interesting. It's interesting to think about this stuff on a spectrum. I think in economies or marketplaces where there is a trust relationship, generally the marketplace is more efficient, right? And so in the same way that, like moving dollars from one account in a bank to another account at that same bank is really fast and cheap, because there's a lot of trust assumptions built in there that make that fast and cheap versus, me sending you USDC, especially in the last few days, being very expensive. But that's the trade-off, right? Like whenever you have more trust around a system, the system can use those trust assumptions to be more efficient. And the more trustless you go, it's going to become more expensive because that it's precisely those economics that like are allowing you to create the trustlessness of that system, right? And so I think that spectrum will always exist. And so, OTC, like one trading desk and another trading desk, want to settle some OTC trade, and maybe, they have like a 2-day grace period because they've traded a lot with each other and they trust each other. Like, I don't think those types of essentially human relationships are going away. And so, as long as those things kind of exist, I think a lot of these financial transactions will only take on as much trustlessness as they need to. That's like sort of the economic way to think about that. And so if there are trust relationships that exist in the world, then there ought to be a lot of transactions that still take advantage of that. And so that's my sort of like long-term, framework for thinking about like the coexistence of C-DeFi and DeFi. But on the other side of that, DeFi, the platforms are getting better. We're getting L2s. We're going to get L3s eventually. The spectrum of trust assumptions become different. So, if L3 has if an L3 has a centralized sequencer that like, rolls up to a decentralized L2, which rolls up to a decentralized L1, and you're doing a transaction on the L3, is that C-DEFI. I mean, you start to get into a lot of gray areas. Yeah. And so I think that particular question is a question of like the moment that we're in today, but I don't know that the boundary is going to be nearly as clear going forward.
Yeah. Going back to DeFi and going back to Frax, you guys are quite powered users of Frax, and you guys pay attention to governance. Hell, you knew about the rage quit discussions going on. So I'm just wondering, as users of Frax and being part of the community, what's your feedback about it? What do you like about it? What do you think can be improved? Go ahead.
Yeah. So I think, this is something that I've communicated to Sam at several points as well. I think there's probably still a bit of ways to go on the governance side. There's, there was some discussion, I think, last year at some point around the multi-sig, things like that. Generally speaking, as protocols scale up, I think there's just, as almost like a social contract with the community that you're interacting with, you need to like button up on the governance side, and I know they're working on it. So that's all great and all, but like that sort of feels like sort of the next step of maturity for the Frax ecosystem for everyone to be able to say, hey, look, there's like a multi-sig involved, but like there's a maybe a DAO token like override or something where you can credibly point at it and say, hey, this thing is like truly decentralized control among the token holders, and then. I think another area is like it's easy for people, this kind of curve and curve wars and this type of game is really fascinating and fun to play in, but I think it's easy to kind of get caught up in that a little bit and lose sight of the final goal, which is actually to have, whether it's Frax, the USD Frax or FrxETH or whatever the FPI or, whatever the next thing they come up with, to actually have that be used everywhere and for people to feel like this is the best way to hold dollars or this is the best way to hold ETH.
The risk-free asset.
Yeah, that's the ultimate goal, right? And so, I think this is probably more feedback for the community maybe, but like, keeping our eyes on that goal and thinking about what are incentive programs or partnerships or things that we can build towards, driving them. We have this amazing economic engine to incentivize that, but that's the long-term game, right? And so there is a risk that if we get too caught up in the kind of like fancy tokenomics of the short term, that we kind of miss the forest for the trees and end up in a place where a more long-term oriented protocol might actually build the truly lasting value proposition that Frax is trying to build.
Yeah. So what are those, implementations and incentive programs that Frax could do to increase its, I think the definition is monetary premium, people holding Frax for the sake of Frax, using Frax for the sake of Frax.
Yeah. So, I mean, I think the gauges are like a big part of it. I don't see the same amount of, like Curve just seems like, if you're doing any kind of stable asset or pegged asset, like Curve is just like, you have to go do that, right? All the founders that I talk to are like, yeah, like we're going to go set up a Curve pool and we're going to get on the gauge and blah, 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 blah. Like that, like Frax hasn't been elevated into the mind share to the same degree, right? And even though like, if you get on like, Fraxland or FraxSwap and you can like, incentivize liquidity there, you can start to play this similar game with these things. But for whatever reason, we haven't quite gotten there. That probably has to do with some of it with with Curve being there first and having a more broadly distributed community. But I suspect that like if the community could somehow reach out to a lot of protocols and make this value proposition to them, just in the way that like I think a lot of during last year, 2021, 2022, there were a lot of conversations about Frax being sort of the de facto stablecoin on like an alternate, like a EVM compatible chain, right? Like those are the types of partnerships, those are the types of opportunities to like be the first liquidity in for, something that's taking off, to really like cement your like value proposition as a stable coin, as a source of liquidity. And so, maybe it's like the DeFi, or maybe it's the crypto bear market in general, that like there's not as many opportunities like this. But I think going forward, like this is the strategy that the community needs to kind of like internalize as a whole if it wants to see this thing really work over the long term. Otherwise, we're just kind of shuffling ownership around through these like tokenomics schemes, and maybe we might end up in a situation where like, essentially Curve and Frax are merged, but without that sort of monetary premium, without that desire to hold Frax, like it kind of is meaningless at the end of the day.
Yeah. Well, I'm reminded of Olympus and its forks in 2021, where they did actually just hold Frax for the sake of it being Frax.
Mm-hmm.
They had massive treasuries, hundreds of millions of dollars in Frax. And Frax, once Olympus had Frax in their treasury, it became the de facto stablecoin of all these home forks. I wonder, and you bring a good point with the new chains coming online, like, maybe if Frax is like early there, it becomes like the stablecoin for that chain, and the chain grows, it grows along with it. So it's, bringing along partnerships there. There's a lot of work to be done. Frax does have the WETH replacement program for FrxETH. I wonder if they can do something similar for like Frax, and that will probably come out after Frax V3. And which leads me to my next question: can you give us any hints on Frax V3? Have you heard any murmurs, anything through the grapevine?
I have. Sam has dropped a few hints to me, but one of the things that we try to be very careful as investors and things is to not steal the team's thunder. So
of course,
I will let him release those bits of information as he sees fit. But I will maybe just echo sort of one thing that I said earlier, is that I do think the natural trend for DeFi protocols is vertical integration. As soon as you have a capital base, like I said, you want to monetize it in every way, which way is possible. And so I expect, whatever V3 is, it will end up building some new primitives, some new ways to monetize the capital that the Frax protocol controls. And what that looks like exactly, I'm not even sure of yet. But that's the natural trend for all these things. And so I would not be surprised if they come up with some new protocol that is a way to use the dollars that Frax owns, or that ETH that Frax controls to generate more revenue.
Go ahead.
I just want to ask, Ken, is there an area in crypto DeFi that you feel that you want Frax to explore a bit more, but currently Frax hasn't? Like, for example, the eigenlayer and restaking kind of side of things. Anything that pops into your mind that you wish you see more Frax action on?
Fraction.
Yeah. I think they're going after something that's already like huge anyway. So I would probably have the inverse reaction, which is inverse free action. I don't know. That I wouldn't want them to spread themselves too thin. I think playing like obviously the stablecoin market is still, the USD stablecoin market is still enormous, and I think we're just scratching the surface of that. The ETH liquid staking derivative, the ETH stablecoin market is also going to be huge, and we're still scratching the surface of that. So like, honestly, if they nail those two things, they're going to then have a lot of flexibility to go into whatever they want. So, I think the Fraxian kind of, to your earlier question of like one of the drivers of their success, I think is also focusing on the right market, right? Like stablecoins, they're hard, but if you get them right, there's just like absolutely enormous markets. And that's why we still continue to see them at the top. If you think of Maker and Frax and then Curve sort of, being at the top of DeFi Llama, like that's no coincidence, right? Like a lot of people want USD. And so keeping your eye on the big market and figuring out what you can do there is, for any kind of entrepreneurship is a key part of being successful.
Yeah. So going out like, maybe like 2 years, 4 years from now, where do you see DeFi and where do you see Frax within it?
Yeah. Well, I mean, there's hopes and dreams, and then there's what might actually happen. I think DeFi will. I'm excited for DeFi to continue to explore what I feel like are truly like native, crypto primitives. So like we were just talking about with Hourglass and Vote Escrow, I think this idea that you can express a statement, some promise about the future, and have this platform that like enforces it in a neutral way is actually like a really crypto native thing. Right? It's like, how would you do that in TradFi, right? You got to have some contract, you got to have some counterparty. The counterparty goes away, then what happens? Like my house mortgage at First Republic Bank. What happens when JP Morgan takes over there's all these like weird kind of questions that go away when you do it as smart contracts. And so these I think we're still scratching the surface on some of these like really native constructions in DeFi. And so I'll be the first to say I'm not going to be able to predict 90% of these, but I know they're coming, right? Because now people are starting to think of not just about we've gone through all the startups of like, well, let's that thing exists over there, so let's try to build it on chain. We've gone through a lot of those ideas, and now people are realizing, oh, actually, here's the DeFi native thing, or here's what DeFi needs right now. Let's build this one piece, and it turns out that we can generalize this thing into a bunch of different use cases. So, so that's sort of DeFi in general. I think the big sort of external factor is kind of what happens around the regulatory side of things, and we don't have to go deep into that, but I think in terms of where it happens, who's actually building it, who actually benefits from it, those are all very open questions in this space. In terms of Frax in general, like if they can figure out how to scale the liquidity in both Frax and FrxETH, I think it's going to be an amazing spot. Right? Like that's like that again. That market is so big that if you can just be a top 1 or 2 player in those markets, that's
both.
Already
Let alone one thing, but both things. Like
shit. And if it becomes the de facto way of like expressing any kind of stablecoin and this sort of stablecoin maximalist kind of way of thinking, like that's that's like hundreds of other asset types that work that way. So
Speaking of building, we're going to have a Frax Hackathon pretty soon, Frax Build. That just got approved through governance. And I'm wondering if you have any ideas of things you would like to see built in the Frax Hackathon. I've been talking to a few people, talking to the team, talking to others. Some people say, oh, maybe you can build like some options market. Maybe you can build like more infra for devs. Maybe you can build more front ends. Like, what would you like to see built in the Frax Hackathon?
Yeah, I think more front ends would certainly help. That's just helpful from kind of decentralization in general. I do think Curve plus Frax, like if you want to really get into the real depths of it, it's pretty impenetrable for like most normal people right now.
We know.
Yeah. So I think there's that aspect of it. Even like, we have things like yield aggregators, right? Mm-hmm. But I think most yield aggregators are kind of focused around like USDC, right? Like, or ETH. What if someone built a Frax yield aggregator, right? Like, where is the best place to put my Frax right now to earn rewards, right? Where is the liquidity most needed? Like, how do I combine all these different incentive programs that between Convex and Frax and all these kind of things to optimize where I put stuff? What does that end up looking like for FrxETH? I think we probably haven't really gotten there yet. But to the extent that this becomes a bigger and bigger ecosystem, with a lot of choices that users have to make, having UIs and products that help them make that choice, I think makes it a lot easier for folks that are interested in the ecosystem to come in and actually sort of be helpful and productive. That's probably like a big area. I think there's probably some things around, stake FrxETH and doing some like more interesting derivatives on top of that. One of the things that I've heard a couple times recently is this idea of having kind of DeFi, like covered options positions where the collateral is some kind of yield generating asset. That's like a really, again, interesting version of rehypothecating some, collateral asset that maybe is like the DeFi way that we do, cross margining, right? Which is like an important thing in options. And so maybe there's something along those lines, but that kind of stuff tends to get pretty in the weeds really quickly. And I think there are probably simpler things, especially if you're talking about for a hackathon, that would just like make it easier for people to like participate.
Yeah, make it easier to participate. And you bring up a good point of like, Frax and Curve, they're hard to understand. Like, it's not like you walk in day one, you're like, oh, yeah. I get it. It takes, it kind of takes, this interdisciplinary approach, whether it's like understanding how money works, understanding how the world on chain works, and then years of experience. It's a whole thing. So how do you think we get more people educated in this regard of like how Frax works? Like, what do you think is the way to go? And like, how can we get people to develop, the same conviction levels as we all share around Frax?
Yeah. Well, I think, stuff like what you're doing is certainly helpful, kind of putting out educational materials. I think in general, like crypto projects and especially DeFi projects don't think about user onboarding very much. And what is the journey to go from like, normie to like Frax, DJ, right? And for a long time, I think it was somewhat okay because I think DeFi in general, its real value prop was that it sort of it offers a set of like high risk, high reward opportunities that maybe are hard to find equivalents in TradFi, right? And so I think for places that have capital controls, places that have barriers to entry in those types of asset exposures, like DeFi was a place that you could come in and do that. And so when you have that, then the sufficiently motivated folks that want exposure to those types of opportunities will figure out wallets and all this kind of stuff, right? But as we sort of move down the food chain or up the food chain, or whichever direction you think about it, there's going to be less, like the people that are coming in are going to be less and less motivated, less sort of like intrinsic motivation to adopt something. And you see this in any product, right? The first organic users, early adopters, they have some real reason to use the thing. And so they'll come and use your crappy product because they get a lot of value out of it. As you sort of go down that tail to users that are like, well, maybe I'll use it because my friends are using it, or maybe I'll use it because, like I sort of heard it's better than this other thing, but I don't really understand why. Those are the types of users where like you really need to reduce the friction to onboarding and make it as simple as possible for them to get engaged. And most DeFi protocols are just not at this stage yet. Like it just takes a lot to get there. There was another part of your question that
I said what do you think it will take? And I think you partly answered it. What do you think it will take to get people to develop the same conviction level as all of us?
Oh, right. Yeah. So I think conviction's a tough one because it's not just about what Frax is, right? Mm-hmm. It's about everything else that right? So in my case, it's the hundreds of founders that I've talked to. It's the hundreds of DeFi protocols that I've seen, tried, and most of them don't really go anywhere. It's having a perspective on the market, having a perspective on regulatory, all these kinds of things. All those things combine to make me sort of see, specific attempts, specific projects, specific founders, specific markets as being particularly interesting. And that's where conviction for me comes from. So, without all that context, I can't evaluate some particular design or some approach, from the next. I can't differentiate the two, and therefore, why would I be more into one or the other? But so I do think a lot of this is actually, one is just providing the direct value prop, like, if Frax actually does end up becoming the best way to express dollars on chain, then the value prop will be obvious. Like if it's if for anything that you want to trade into, it's the easiest to actually just hold Frax, and because the markets against all the other assets are the deepest in Frax. Like if you get to these properties, then it will be self-evident, and the value prop will speak for itself. Let alone some of the network effects that come out of that. But I think a lot of, outside of that is actually helping people understand why the Frax team or the Frax mechanism is special. Like, what do they need to, like, usually it's like people need to understand something new about the world that they don't understand already to understand why crypto is important, right? And then once they get over that hump, like, okay, well, between Tether and USDC and Frax and Maker, like, what are the things that you need to understand to see that Frax is actually the, one of the more interesting constructions of this stuff. So I think it's actually building that context with people that then naturally leads them to have conviction in the same things that you do. Yeah. And it's less, it's less about just explaining what the thing is, because if they can't evaluate it in context, then
it's about everything around it.
Yeah. It's sort of like how you see the world, right? Like, if you think the world is going to go in a certain direction, then you'll naturally have more conviction about things that you think are aligned with the way that the world is going.
And speaking of the way the world is going, I want to zoom out a bit away from Frax, away from DeFi, and kind of look at crypto as a whole. For you right now, what is the one thing that you feel folks in the crypto space are ignoring that you are excited about?
This gets back to some of the Hourglass conversation, but I think like tokenomics sort of has like a bad rap right now. I've actually talked to a lot of founders that are very skeptical of it right now. They saw a lot of, they saw on the Ethereum side, there was a lot of like, DeFi summer like didn't work, like liquidity mining doesn't work kind of conversation. If you kind of go into like the Solana realm, like people are like really allergic to it over there right now. And, because a lot of the tokenomics schemes for some of those protocols were like very, very short-term oriented, right? And with predictable results. So I think, aside from being in a crypto bear market right now, I feel like we're in a tokenomics bear market. Mm-hmm. But actually, like, I think tokenomics is like one of the superpowers of crypto, right? Like the fact that we can express these funny, bespoke, long-term incentive, agreements, co-incentivizations of things, and do them in these like very like micro and automatically enforced ways. Like that seems like a superpower to me. And the fact that people are kind of bearish on it feels like you're like, why are you even building here if that's like not the right. That's not the thing that you're gonna use, right? This is literally the thing that this platform can do that nothing else can, right? And so I continue to be very excited about tokenomic innovations. That's what I'm very excited about, Hourglass and these types of things. But yeah, I mean, I wish there were 100 times the people thinking about this and excited about this, because I think that's where a lot of the innovation is going to come. And like part of that is I've also lived through kind of the open source movement, right? This is one of the other big technological shifts that we see in space. And open source really showed that like a lot of this software technology becomes commoditized. And I really expect, especially in DeFi, that the same thing will happen. Whoever builds the best AMM construction, eventually everybody's going to be using it. Whoever builds the best lending construction, everybody's going to be using it. So it's all open source already anyways, right? So then what is the thing that actually like makes anything defensible, right? I think it's going to be community and long-term alignment and like this kind of collective risk-taking to say that we're going to congregate around this particular set of protocols or that particular set of protocols, this governance token, this treasury, whatever it is. And the thing that underpins all of like growing those kinds of communities is the tokenomics, right? So if I think about it over the long term, like folks that are just focusing on primitives right now, like, oh, we can build this new type of marketplace or, whatever. Like, that's great. It's cool math, awesome technology. I think I have trouble seeing them work over the long term because they're missing the most important piece.
Okay, I have a question for DAOs. Do you think, participation in governance is better expressed with tokens or with NFTs? I'm not talking about like Frax. I'm talking about like more like your social DAOs and other like formations of people on chain.
Yeah, I mean,
like you see the llamas, yeah.
I think at the end of the day, like DAOs will be such a generic concept that the answer is going to be both. It's sort of like a false dichotomy at this point. Certain types of financial things where it's something's on a continuous scale and you need to be able to like express votes easily in a very kind of like high granularity. Probably fungible tokens make more sense. But there are certainly lots of things already even in the real world, which are sort of membership based or, maybe only want 100 or 1,000 or, some limited number of set of people that can come in. I think for those type of things, like something that probably looks like an NFT ends up being more useful.
Now, I'm going to do a fun little experiment. Hypothetically, what could a FLYWHEEL token look like?
Yeah, I think it's interesting because like most of what you guys do is like pretty off chain.
Yeah.
And so really it would suggest to me that there's some kind of like coordination aspect to what you guys do. That,
and we do have a treasury. So
yeah. So, like ultimately, like I think your guys' like value is distribution, right? Like, but for people coming, as you build your audience, coming on the show, being able to talk to your audience has value. And so most of, I think, tokens that work because you're taking something of value and letting the token holders control it, right? And so in your case, if your main value proposition is the distribution, then if there's a way you can set up token holders to be able to control that distribution, like maybe decide who comes on the show or like, these types of things, that's where something like that might work. But it's the fact that you're doing it off chain, makes it sort of like there's a lot of trust assumptions built into like, well, okay, just because we vote on a snapshot, does that mean Dave's actually going to bring this person on? Like that's like a big trust assumption. And so I would probably suggest that like at least it's not one of the initial use cases that I would think of as like being particularly suited for a token. Someday, I suspect most things are going to have this property, and maybe there'll be some way for you to express on chain through a smart contract that you're going to have this person on your show, and you get like slashed if you don't do that, or something like that, right? But until we get there, like there's not like a ton of benefit of doing it on chain today.
Yeah, I agree. I thought it was a fun little experiment.
Yeah, but I think if you have like membership NFTs and like just kind of do it for fun, like that's sort of the beginning of something, right? And so, I think if you're able to if you're able to construct it in the right way, and you get a lot of enthusiasm around owning these things, and that allows you to grow your audience in a way that traditional marketing channels or traditional growth tactics have been unable to do, that's where it potentially becomes interesting, even if it's not fully off-chain and verifiable, and et cetera, et cetera.
Yeah, I actually, this year, I've joined 2 organizations with NFTs. One was Crypto Nomads, because I travel a lot, and they do a phenomenal job, honestly. Like, they host these, like, these ramen DAO dinners. You get, like, you buy, like, a sub-DAO NFT, and you go, you meet like-minded. I was like, wow, this is pretty cool. There's a group chat. Like, I feel like I'm really getting value out of my NFT. So shout out Crypto Nomads. And recently, I just got back from Zuzulu, and I learned about this network state called AfroPolitan, which is this Pan-African network state. And they really have a a why for existing. I had dinner with one of the founders right before I left, and it's like, the people, like, in Africa, they don't really have much leverage with their passports. They don't really, the nation state system was not just like trampled over them. Let's be real. And so, like, the network state is a very natural fit for them. And, AfroPolitan was started even before network state was a concept. So, like, once Balaji coined that term, like, they were right on it. And so, and what I liked about it is, like, it was, even though it's like Pan-African in like its theme, it's like anybody can like go join. It's like, as long as you like share their like one commitment of, gaining abundance and everything. Like, I really liked the mission. I'm like, this is like the one network state experiment I've seen that like truly has a chance of like becoming something, because it has such a strong why. And so I bought one. I bought, like, when they have 500 founding citizen NFTs, and I bought one. I thought it was really interesting what they're doing.
Yeah, totally.
I was like thinking to them, like, oh, and like they were thinking about stable coins. I'm like, oh, like, how would like this network state release a stable coin? Like, what would they adapt?
Yeah, what would their stable unit of value even be, right?
Would it be like,
would it be dollars?
Would it be dollars? Would it be something else? Like, would it be each stable coin? But yeah, those are some interesting membership NFTs.
Yeah, and one thing that reminds me of is back to our kind of Web3 social conversation. I think NFTs are actually the beginning of Web3 social.
Yeah,
right? Like, social happens when you see people organizing using some medium, right? And not all NFTs are like this. Obviously, some people are just trading JPEGs around, but like, there are certain NFTs that feel like communities, and especially if you're talking about things where maybe at some point you have to like pay dues to like hold on to your NFT. Those things are those things usually exist in the middle, like a country club membership or something like that. Those things are all there because they provide you some kind of social value that's not sort of a token or not a financial in nature, but there's some value in being associated with that group. And if that's not social networking, I don't know what is.
Yeah, that's the original off-chain social network. But I'd say that along, not only with like membership fees, like a lot of NFT projects sustain themselves just through the royalty fees and whatnot, and trading fees and whatnot.
Yeah, totally. Yeah, but I mean, I think that's like V1 of this stuff, right? So yeah. If you could imagine, like, if, I don't know, pick a random one, pick Azuki's or something. If they keep throwing really awesome parties and they become known, you have to have an Azuki to get in, right? And they're like, well, like, maybe the way to fund this thing is actually just to collect
dues,
like fees from people who want to come to these parties. Maybe there's an equilibrium there that works, right? And like, just the fact that you get access to these parties, plus like, maybe the people in that community are like super, interesting to get connected with, and you get some excuse to see them. Maybe that works. I think colleges to a large extent are going to end up being this type of thing too, right?
Yeah,
so,
you can say like you pay your taxes to get your passport. So yep, same thing.
Yeah, totally.
Ken, as a Flywheel community member and as a potential future Flywheel token holder, let's speed run some governance here. And who do you think we should have on next as a guest that you'd love to hear from?
So we're going right into the lightning round.
Ooh, interesting. That's a good question. That one I didn't prepare for. My kind of initial thought is, I wonder if there's like anyone on like the regulatory side, that might be interesting. That might be deep on stablecoins. There's not a lot of them, but there's like, there are certain politicians that are pretty deep on it. Certainly their staffers.
If you know of anyone, I'd love to have them on. I'd love to have them on.
Yeah, that would be an interesting one, because I think you might get a different angle just to get a different take on what stablecoins are. I think there's potentially also a lot of these folks that are working on kind of this like T-bill tokenization, like a new type of fiat stablecoin. Some of those founders are pretty interesting. I don't know. Did you guys already bring the Ondo guys on, or like?
Yeah. No, sorry, not Ondo. No,
not yet.
Yeah, so there's just sort of like there's sort of like 1 foot in real world assets and 1 foot in like stable coins, on-chain stable coins. There's probably like an interesting set of founders there that might be pretty on topic for you guys.
Nice. I'll take the next one. So this is our this is our lightning round. So you
Sure.
can answer these questions sharp, fast.
Yeah.
What would be some advice that you would give to your younger self?
Ooh.
College age Ken coming into the world.
I think I've always for a lot of my life I think I had this kind of perspective that if I wasn't learning anything, I should move on. And so a lot of the times which I've decided to move from one job to another or one thing to another is when I felt like I stopped learning. But knowing what I know now, I would actually go back and tell my younger self that actually it's when you become comfortable is the moment that you should switch. It's there's something about real learning. There's something about real growth that feels very uncomfortable. And all the times that I look back and say, oh, I actually did that because it was just the easier thing to do, the more comfortable thing to do. Those feel like kind of lost opportunities and lost time in the past. So it's kind of it's a bit of a nuanced thing. I don't know if it's, but
get comfortable feeling uncomfortable.
Yeah, exactly. That's how you know. That's how you know you're making progress.
Yeah, it's your muscle only grows when you work out and tear them.
Yeah, totally.
Yeah, Sam knows that.
Yeah, and Ken, what was your virgin crypto experience? When did you first touch the blockchain?
Interesting. So I have a funny story because I was at VMware in 2009, and VMware has a bunch of open source engineers there. So we actually were talking about the Bitcoin white paper, literally the week that it came out. Someone got a sense of it.
He touched the white paper.
Yeah. Well, no. So I mean, it was really funny though because we were talking about it from a systems point of view, saying oh, this the fact that you're using sort of economic principles to solve this, what people thought of as a computer science problem was really fascinating. And we were kind of argue about whether that works or not. And most people are yeah, it probably works. It's kind of a weird new thing, but probably works. The money side of it, everyone was there's no way that the Bitcoin, the actual coin part of it is going to work. Why would anybody use this thing? Right. And so that, that was my first touch. And so I have this really weird experience with crypto where almost from the very beginning, I kind of understood it technically, but it wasn't sort of the main thing I was focused on. And I kept seeing this stuff on the side of oh, Bitcoin hits $10 or someone orders a pizza with Bitcoin and all these kind of weird news stories.
So you're just seeing it go by.
Yeah. I'm what the hell, I'm obviously focused on, what I was working on. So I wasn't paying super close attention, but I just see these bits and pieces. I'm I still don't understand. Why is anyone caring about this? I kind of didn't get it, for a long time. And so I would say, it was really when I started, in 2017, I was still at Facebook, but there was a moment where, obviously, 2017, people were going crazy. And literally every sort of one-on-one conversation that I was having with someone on my team would start with, oh, Bitcoin's at, X, Y, and Z, and here's what I'm going to go buy. And, whatever, I'm okay, this still sounds crazy, but it really reminded me of something that I think echoed one of the reasons I joined Facebook to start with, which was that you could feel that this thing was spreading on its own, right? Facebook had this property. My parents got onto Facebook before I told them about it, right? And so I'm when is the last time that has happened, right? And so now I'm I'm very attuned to situations where something seems to be spreading like wildfire, because usually, that means there's some product market fit or some network effect or something that is working there. And so that moment in 2017 is when I started to say oh, you know what, this is not just this technological curiosity. This is actually bleeding, and obviously, Facebook employees are a pretty biased subset of people, but even within that fairly large population, everybody's talking about this. There's something going on here that's beyond, just being an interesting sort of, distributed systems thing. And so that's where, for me, I started kind of getting into it. But really, I think, once I started Electric and started playing with a lot of DeFi systems back in 2018, that's where it really clicked for me. It's like, oh, this is just like a totally different way of doing things that we do with
A
money.
fellow member of the class of 2017.
Yeah.
Woo! and to do the complete other side of that, what is your favorite off-chain touch grass activity?
Oh, interesting. I just, I feel like I'm so back to back when I'm working that I actually just like to go to nice places and like literally do nothing. Like just sit on a beach. Like it's literally the value is like the freedom from that mental stress of like always having to worry about, oh, what do I have in the next 30 minutes? What do I have in the next hour? Like that stress, if I can just get away from that for like a day, like that's always amazing. So I don't know if that counts as touching grass. Usually I like to do it in a place where you can touch grass, but
that is like the most touch grass answer
Yes.
I have heard, because you're not doing anything. You're just
It's the
being.
epitome of touching grass.
And like I might actually end up doing something if I feel like it, but it's the freedom from the obligation of having to do something that was like scheduled a month ago that is like extremely like, at least for my brain, seems very restorative.
Yeah.
And Dave, go ahead.
Do I have any more? I think that's it.
I have the last one. I have the last one here to wrap. Ken, if you weren't in product and you aren't in tech and you are not the prolific investor you are, what would your other life career path would have been?
What's Ken doing on a different timeline?
Yeah, I think I probably would have been a doctor. I really like medical stuff for some reason. I like read PubMed for fun sometimes. So like just this like just like this natural curiosity towards like how humans work and like kind of biologically and it's just like it's like infinite complexity, right? And so I think I'm like naturally attracted to that kind of system. Obviously a very different set of stuff that you have to learn to be useful at all in that domain. But I'm an armchair doctor sometimes.
Wow.
Well, Ken, thank you so much for joining us. We're almost closing in at 2 hours. This was a marathon of an episode, but it felt like a sprint because it just time flew by. I really enjoyed every minute listening to your insight and your frameworks. Not just how you view Frax and view DeFi, but really how you just view the world. So thank you so much for coming on. Thank you for being a part of the Frax community. You're very valued here, and excited to see where everything goes from here with you, Electric, and hope to have you on soon.
Yeah. Thanks for having me on, and it's great to have things like this in the community. So I really appreciate the work you do.
Thanks. Good evening, ladies and gentlemen. Welcome to the Flywheel post-game show. I'm your host, DeFi Dave, and I'm here with Capital K, and we just finished the episode with Ken Deeter from Electric. Ken was a wealth of knowledge, and it was a lot of fun, that episode. I mean, I always say every episode is fun, but this was like really interesting. Like I was really locked in to everything that he was saying because his frameworks for seeing the world were like very complete. They were articulate. You could follow, like you could. I mean, this is how like proper VCs think. But Kit, what are your thoughts of this episode? Let's talk about it.
I think you nailed it. It is his way of thinking. My favorite question was actually around conviction and how kind of one thinks about conviction. And we always feel like, oh, the way you have conviction is like reading all the threads about this single one project or doing research about this single one project. But it's actually conviction comes from context of everything around it. And that's kind of why it makes this project the most exciting project, because of the worldview you have and the context that you live in. I thought that was like,
yeah. You know what's funny about this episode? Like we were asking all these like Frax questions, but then we just like ended up like naturally going to Hourglass.
Yeah,
with that conviction.
we really tried.
Lens.
We really tried to keep it to Frax question, So
I mean,
but there's definitely a lot of Frax content, though. Definitely.
Yeah, no, this is like I feel like I said, I'm happy we got back to our roots here, getting Ken on. But yeah, like what a wealth of experience and knowledge. Like even at the end. Yeah, I like heard of the Bitcoin white paper the first week. We were talking about it from a systems perspective. I mean, like what? Like, and then imagine like you hear about Bitcoin the first week, and then you see it grow since from like and like an idea from like a email mailing list to like where it is today.
Dude, I bet you he probably didn't even think of it as Bitcoin when the white paper came out. Oh,
No,
eCash was probably the thing that like caught on more, right?
or
They
no, he
probably
just
don't
thought of it
even.
as like, oh, like an interesting experiment. Like, oh, you're
Right,
you're solving the
exactly,
Byzantine
exactly.
problem.
Probably didn't even address this experiment as the word Bitcoin. He probably used another name for it. Like,
Mm-hmm.
and just quick sneak peek for the listeners. We're talking about how Ken was there at the white paper of the Bitcoin release
Mm-hmm.
on the forums. Okay, that is
Mm-hmm.
the crazy part.
Yeah, and it's I really liked. What was your? I mean, there's so many different parts. I'll go into like my favorite part of the episode was when we were talking about decentralized social, and like what Web3 social
Oh,
looks
okay.
like. Because I've been like thinking about, you know, after like coming back from Zuzulu and like there's a lot of talk about identity online, whether it's like how do you represent that? How's that shown? How's that shown in a Web3 context? And I think he put on a really good lens on how to view on how what it could possibly look like, because it's not going to look like Web 2. And I like to Web 2 does a great job of proliferating crypto in Web 3. So like a Web 3 social is going to have to perform a different function. It has to be like a different shelling point to like gather people in one place. And so they gave me like more color on like what that's going to look like per se. But anyways, like what's your favorite part of the episode?
I think near the end when we asked him like what was the one thing people are ignoring, and
Oh,
tokenomics was like so
dude.
spot on.
Dude,
Was
I want
so
to like
spot
go.
on.
Yeah,
Yeah,
yeah.
yeah. And the reason why I liked it was because everybody is literally poo-pooing tokenomics, like left and right. When he said, like, nowadays when I evaluate a project or look at projects, I almost look at tokenomics as a kind of like a given, and almost like everybody has it and is all copy pasta of one another. But the way he was positing it was like, well, no, your tokenomics could actually be a moat. It could be actually defensible because so many things spawned out of your tokenomics. So even if your product is like the super sick NFT perpetual with no liquidation and blah blah blah,
It could just
at
be
the end of
copied.
yeah,
It could
yeah,
be copied.
at the
Yeah,
end of the
it
day,
could be
that
forked.
tech can be copied, but the tokenomic side of thing, like that is unique. Like your token will be
Yeah,
yours, only yours.
yeah.
Um,
I really
yeah,
liked his language and how he described things. It's like tokens are a way to express this belief on chain. Like, oh, you lock in VE, you're expressing your long term commitment to a protocol. Like, I think like that is the right way to think about tokenomics from a long term, from an actual like fundamental long term perspective. It's like, okay, like I know these people are committed to the protocol because like they're staking, or like, okay, like I know there's like people, there's gonna be shit happening here because there's locked liquidity. This is like an episode like we'll definitely have to listen to again,
yeah.
because I'm sure there's
Again,
so many little trinkets.
are there? I actually got a question for you, Dave. Are
Mm-hmm.
there any areas that he talked about that you disagreed with, or any area that you want to hear more about?
um yeah, I guess like I'm curious to learn more about like it's I guess about the monetary premium of Frax, increasing its monetary premium, because that's like a tough problem to solve. And it's like, what is the solution to that? And I'm not sure if he really like gave one per se. I think it's like one of those things that like grows like naturally. I think he was like maybe like knocking Frax I'm gonna defend Frax, like Frax a bit too much. I mean, Frax is like barely even 2 years old, and it's like grown to 1 billion and like bootstrapped itself in a certain way. But like I do have to agree with him, like, yeah, like it's where can we like grow and expand beyond the curve ecosystem? I think that's like probably the most common criticism of Frax is like, like, yeah, curve's great and all, but like what else is there for you guys? But like there's plenty, I think there's like a lot else out there, as I pointed out with like, Olympus Down and its forks, like some using Frax in its reserves. And I think, once like Frax V3 comes out and we find out what it is, and it's the risk-free asset of DeFi, and people like use Frax for the sake of it being Frax, and use FrxETH, and FrxETH replaces WETH, then like, it's game over. And yeah, that's me being biased and super bullish, but so yeah.
No, I mean, I am too. So There's not much for me to say outside of that, but regardless, I think my other bit that I wish Ken elaborated a bit more on was the way he assessed risks for a investment into something like Frax in the very beginning.
Yeah,
Because hearing from a founder saying, "Hey, I'm going to take on the dollar market," um, wait, say it
expressing
again.
dollars on chain.
Yeah, like say that again. Like how did he assess risk at that point in time? And how did he kind of adjust risk over time?
Yeah.
Because remember, he kept on saying long term, long term, long term, and obviously the 4-year was just a CRV thing that just happened to stick. I wanted to hear like what his long term thoughts were when they cut that investment into Frax.
I wonder how T-bills are on chain too. I'm not sure about that either, unless like there's like some pass-through system where the interest of the T-bill goes to some like non-profit or something, and I it's just like at the end of the day, like until like regulation is clear and frameworks are set, it's like hard to like have these things on chain.
Yeah, it's definitely I think it's more of an accounting and labeling thing in my opinion, because quite frankly, and this is just a thing that I was thinking about, if theoretically there is a fiat stablecoin and this fiat stablecoin has US dollar at or holds treasury with the US dollar that it custodies, and let's say it needs to incentivize on-chain liquidity, it could theoretically just rebrand the yield distribution of the T-bill as a marketing spend for on-chain promotions
Mm.
via bribes. They would literally be bribing with US dollars, which is unseen, like never seen before. It's like USDC coming in and be like, yeah, I'll give you guys some USDC for incentivizing my
Talk
curve
about a
pool.
war chest, and talk about like as if I said this in the beginning of the podcast, like like JP Morgan going on chain. Imagine if they do that, if they like enter the JP Morgan has entered the chat.
Boom. Oh my god, dude, the day
Yeah.
that we see JUSD dropping on the curve proposal to request for a gauge is when like, all right, like that's the look ma, we made it moment.
Yeah.
You know?
All right. So final question. What is your biggest takeaway from this episode?
Ooh, okay, come back to me on that one. I'll let you go first. Let me think.
Let me think. I just want to have him on again to like in like 6 months and like go like see how things play out. I mean that's not really a takeaway. We're in the right place with stablecoins and stablecoin maximalism. I think stablecoin. My biggest take. I think like I think every day more and more I get convinced of stablecoin maximalism being like the structure for DeFi protocols to gain the most value on chain and grow and scale on chain.
Yeah,
I'm not.
no,
Yeah. And like how like that was kind of discovered through experimentation, like the structure of stablecoin maximalism.
Yeah, I would have to agree. I would have to agree that it reaffirmed my belief kind of in Frax, and especially when I kept on asking him like what else should Frax do, or should Frax improve here and there, he really got to the nitty-gritty of it and be like, well, no, actually Frax should stay focused exactly where they are. And
Yeah.
second,
And
they should make it easier for people to use what they're
use it.
currently
Yeah.
focusing on.
And notice how he said like he didn't criticize Frax for like building so many privileges. In fact, he was like, no, it's good that they're shipping in a very focused and intentional manner. But yeah, I think like got great feedback for the hackathon. I think like we're gonna like really focus on like onboarding front ends, onboarding devs with infra. Something else I talked about, and also like I never thought of like Web 2 being like the field for like Web 3 to play on. Like none of this would like we would not be having these conversations if it wasn't for like Twitter and Telegram and whatnot. But anyways, we're over the limit for this post game. So if you want to keep on joining us, harnessing the power of the flywheel, make sure you hit that bell button, subscribe, leave us a comment, let us know what you think, give us a like button. We'll keep coming back week after week, day after day with more of these things, more of these episodes. If you want to find out more, go to our Twitter at FLYWHEEL DeFi. Join us on Telegram at FLYWHEEL DeFi. You can follow me on Twitter at DeFiDave22.
You can follow me at 0xcapital_K.
And we'll see you next week. Everything said on this episode is not financial or tax advice. This channel is strictly for educational purposes and is not an investment advice or solicitation to buy or sell any assets or to make any financial decisions. This video is not tax advice whatsoever. Please talk to your accountant and do your own research.